Good, Rob.
Hi, it's Rob Sedaghatpour and Mitch Flaherty from the Stratco B6 webinar series. Today we're here with our guests, John Boykas from Eisner Amper, Jeff Feinstein from KBK Wealth Advisors, and we're giving an update on the Inflation Reduction Act and its impact on the real estate industry, both from investment standpoint on current assets and also an opportunity on how to navigate it. So let's start with our guru, John, on how, if you can give us a summary on the Inflation Reduction Act, its goals and key points.
Thanks, guys. It's John Boykas from Eisner Amper. The Inflation Reduction Act is not really appropriately named because it has nothing to do with inflation or the reduction of inflation. It was more focused on green energy projects and that type of thing. However, there are a few items that are related to the tax code. Firstly, and this doesn't affect a whole lot of people, there's a new corporate minimum tax that applies to entities that have financial income in excess of $1 billion. We should all have that problem, but we don't. Next, the Act extended the limitation on the deductibility of excess business losses by non-corporate taxpayers, which is really partnerships and individuals. This has been in the code for a few years. It was supposed to expire, allowing businesses to take the full benefit of prior losses, but it's been extended in effect to pay for some of these green energy projects. In addition, there's an excise tax of 1% when corporations buy back their stock. Now, there's a whole bunch of exclusions there, so it really doesn't affect most smaller companies. It was really targeted for publicly held companies. The Act extends and expands existing tax credits related to green energy projects and components. Again, this is just supporting the goals of moving to green energy. But probably the most pertinent change that affects the real estate industry is the massive amount of resources that have been allocated to the IRS enforcement. Over the next decade, the Act provides for $80 billion in funding, mainly focused on IRS enforcement. This includes hiring 80,000 new agents, mainly in the audit and enforcement area. This will expand significantly taxpayer audits. They say that they're only going after high net worth people. I just can't believe that's going to be true because there's just not enough of them to keep 80,000 agents busy. The hope that here is that substantially more taxpayers will be getting audited over the upcoming decade. The actual effect of these audits on taxpayers will put a substantial burden on the taxpayer. If they're audited, and since it becomes more highly likely that it will be audited, regardless of what the audit finds, it's a very expensive process. The auditor comes in and looks for a whole bunch of information, which can take weeks and weeks and weeks to accumulate. It'll take weeks for the auditor to interact with the taxpayer and or their accountant. And, time is money. It's going to cost people a fortune. That's the biggest effect, really.
Quick question, John. When you say audited, do you mean in relation to their company accounts or the RPIEs on the assets they own?
It would be taxpayer audits on their tax returns.
Okay.
It'll be both business tax returns and individual tax returns.
Okay. So not necessarily relating to the specific asset as
it's not related to any specific asset, although what typically happens is the IRS will focus on certain areas. So they may look at, for argument's sake, any entities that are not using that have inventory but don't include it on their tax returns. There's been many campaigns that have gone against that type of thing, but that's only just one of dozens of areas that the IRS can focus on.
So Jeff, while there's been this, this green energy movement with this related act, where are you seeing actual inflation impacting interest rates and values and playing in with Mitch's end of the business?
My world is mostly focused on the market and the liquid stock market, and we do look at real estate investment trusts. I would say what the Fed is trying to accomplish is really to slow economic activity. So it's affecting, obviously, the stock market because it's hindering consumer spending, but it's just not making it feasible for borrowing, and the financial markets are tightening. So I think the real estate market is correlated to stock market in the sense that you're not seeing as much activity and as much growth, in both sectors.
So John, is there a playbook on how to navigate the green energy incentives on a local level? Is that, while they gave the outline on the Inflation Reduction Act, but if you want to actually capture related tax credits or incentives on a particular project, do we have that handbook yet?
It's been out there for a while, because most of this stuff is extension of previously enacted programs. So it's really more expanding and extending the ability to get tax credits for these in these green energy areas.
I think it also would be good to hear from you both, Rob and Mitch, for people that are listening in, to kind of hear what, with this act, what you predict with energy, with the real estate capital markets. Mitch, obviously in your world, I'm sure you're watching interest rates more than anybody.
Yeah. Me and Rob actually did a webinar on this a few weeks ago, talking about building strategy and energy efficiency. Rob, do you want to go first to give a quick?
Yeah. So basically, what I found is that the state incentives are giving actual money back at the completion of the project. The federal program, it's focusing on tax credits that got captured after you complete the project as well. When you combine both, using certain labor forces, being of a certain asset type, and being in a certain zip code, you're able to capture over 100% of the actual cost of the installed item. So if you play it well, and you have the right team in place to exercise all of these, on some situations you can capture over 100% of your costs in doing it, which isn't, from my understanding, it's not contradictory, because they're both programs are agnostic to each other.
That's correct.
The federal program and the state program. But the challenge is the attention level we can get from our clients on getting the related documents and focusing on the compliance on both of the applications.
And does that feed into valuations of the building? I mean, I guess that's a question for Mitchell, but if there's more incentive for real estate owners, would more people want to enter the real estate sector as an investment?
Yeah, well, me and Rob were discussing this. I think the main thing is for these owners to be aware of these incentives. A lot of them aren't aware and don't want to do the paperwork. But in terms of obviously, as you mentioned, the debt market is tightening, which is having a direct correlation on upward pressure and cap rates. I think that each asset type behaves differently. Like, I think the majority of buyers that acquire multifamily products are really cash on cash return focused. So obviously, their debt's more expensive. The cap rate is going to be higher, and how much equity they're required to put into the deal. So I think less transactions are definitely happening right now. I think that will continue into early next year. I think that just the rates have got to level off. I think the latest debt quotes, a lot of the clients are getting around 6.5%, depending on the asset where it is. So there's got to be some sort of spread in order for them to get a return on their investment. So cap rates as high as 6, 7, depending where you are. So yeah, I think there's going to be a leveling off. I feel like not many transactions are happening because you wouldn't sell right now unless you have to, because obviously no one wants to sell when they feel like there's the perceived bottom of the market. So just sort of continuing to closely monitor it, and just giving clients sort of real time feedback as it relates to the debt market. But my understanding is inflation, you might know better than me, that inflation's sort of leveling off now around 7%. Is that right?
Everyone uses the term soft landing. Every day it's good and bad news. Today was a wholesale report that was bad news. Last week or 2 weeks ago, there was another inflation report that showed it slowing down. So we just got to keep watching the markets and keep watching reports and just hope, that the Fed sees inflation as leveling, and they're going to, slow down some of the interest rate hikes as it's really affected, a lot of people that work with a lot of clients, et cetera.
All right, so thank you everyone for joining us. I think the key takeaways are the government's temporarily looking to slow down the economic growth. They did release a program to basically partner with you on CapEx projects. And if you're able to focus between the state and the federal incentives, there's a great opportunity to increase your yields on those CapEx projects using outside funding. Mitch will share everyone's contact info. And
yeah, give me 1 second. There we go.
there we are.
Perfect.
Well, great.
Thank you.
Thanks so much.
Thanks.